Hello. Today we will be discussing and continuing with the basic accounting concepts. In our last class, we have discussed few accounting concepts like going concern, cost concept. In today's class, we will be discussing few more accounting concepts like dual aspect concept. So what do we mean by the term dual aspect? Dual aspect actually is the foundation or basic principle of accounting, and it provides the very basis of recording all the transactions which are related to business in the books of accounts. The concept states that every transaction has a dual or twofold effect and therefore should be recorded at two places simultaneously. The two accounts will always be informed while the transaction is being happening. For example, if I give an example to you, if supposedly Mr. A has invested rupees 50,000 into the business, there are two things which are happening. First, that the business is getting cash as an asset. So one transaction will be recorded in the cash account stating that the cash has been received worth 50,000 rupees. Similarly, at an obligation or a liability side, the business's obligation for rupees 50,000 has increased towards the business owner. Right? So this is the basics of accounting, that every transaction has twofold effect on the business. One, it can either increase the asset and increase the liability. It can decrease the asset and decrease the liability. It can increase an asset, simultaneously decrease another asset. Similarly, there can be an enhancement of one type of liability and decrease in another type of liability. Right? So every transaction will have twofold or dual impact on the books of accounts. Then we have something called as revenue recognition concept, or we can also call it as revenue realization concept. So this concept of accounting states that the revenue is recognized of the business transaction as and only when it is realized. So what do we mean with this realization concept? This means that it is a term as revenue and other when the revenue is realized. Let us take first one in this. So supposedly there is an inflow of cash, and this is basically arising out of the sale of goods or services by the enterprise. Right? So cash is immediately received and realized. However, there can be a credit sales wherein the cash would be realized or received physically to us later. But in our books of accounts, the goods have moved out of our business in today's date. That means the sale has actually been realized or recognized in today's date. Though the cash will come to us at a later point in time, but we need to make the record or summarize this accounting transaction as and when the credit sales is made. So this is revenue recognition or revenue realization concept. The next is matching concept. So what do we understand by the term matching concept? The matching concept means that it is the process of ascertaining the amount of profits earned or the losses incurred during a particular period. That means the expenses of a particular period should be deducted from the revenue of that particular period and not from somewhere else's sometime other than this. So, if supposedly all the expenses that have been borne for the year 2021 will get recorded in the books of accounts of year 2021, and all the sources of revenues, be it a cash sales, be it a sales, be it a credit sales, or be it the revenues generated through rent, interest, similar other commissions, brokerage. So whatever the sources of income are, all the transactions which pertain to your 2021 will be recorded in this particular books of accounts, and from all these earnings of your 2021, the expenses shall be made for the year 2021. Thank you.